Somebody can be owning an asset, but still tap into the value of the asset while they continue to maintain ownership.
Welcome to Alt Investing Made Easy, where we explore the complex world of alternative assets. I'm Roland, a securities attorney, investment advisor, and your co-host.
And I'm Sarah, an investment advisor and corporate attorney, and your other co-host. We'll guide you through real estate, private equity, and more, making complex topics accessible.
Tune in for insights that empower your financial journey.
Let's make alt investing easy, one episode at a time.
Welcome everyone to Alt Investing Made Easy. In today's episode, we're delighted to bring to you a conversation we're having with Hunter Albright of Salt Lending. He's here to talk to us about crypto and also a very important topic about the difference between secured lending and unsecured lending and how in his business, crypto is as part of that. So Hunter, thanks for joining us today. Really looking forward to our conversation.
Oh, Sarah and Roland, well, thank you. It's a pleasure to be here. Looking forward to the conversation.
Yeah, Hunter, thanks for being here. And this is great for us because this is a podcast, devoted to alternative assets, and cryptocurrency certainly falls into that category. It's a new asset class. It's been around for a while, but it's gained huge popularity over the past few years. We've all observed that in the marketplace, and we didn't want to lead with it, but it's part of the discussion about alternative assets, and we acknowledge the reality of it, that a lot of people are invested in it, and some people, just as in all things, like there are gold bugs that people just have this emotional connection to it. Yeah. The same thing has to do with cryptocurrency in the sense that there's this element of it being decentralized. It's new, it's relying on technology. So there are all these factors that make it sort of a sexy investment, honestly. But what I like about your story is that you've got this lending component, people being able to access their assets. So Hunter, I think that might be a good place to start with is, just describing Salt Lending and what it is that you guys do.
Yeah, be happy to. So Salt Lending, I'm currently the Chief Revenue Officer for Salt Lending, and Salt Lending started in 2016 really as the original Bitcoin-backed lender. And it started out as a need for the founders who were accumulating these assets, but didn't want to sell them, right? They believed in, and Roland, as you mentioned, right? I mean, some of the background to Bitcoin in particular and to cryptocurrencies has been a philosophical movement about people believing in more decentralization, believing in alternatives that are outside of any one government entity. And so some people were and are committed to that as both a cause and as an asset. And so SALT started to help facilitate that. It is growing now very quickly in terms of the popularity and the growth of the value of the asset. I think Bitcoin now is essentially the fifth largest asset class from an investable asset perspective. Wow. So we're seeing more people, we're seeing more companies to look at doing that, putting Bitcoin on their treasury to be able to both grow the value of the business, but also create, I believe, some cash flexibility in terms of withstanding ups and downs because it is an asset that can be borrowed against so quickly. It becomes sort of highly leverageable and highly liquid. And then with the conversation around government starting to buy it, right, that is just sort of fueling some of the both speculation and awareness of the asset class as a whole.
So, Hunter, why don't you introduce what Salt Lending does? And then I think it would be really interesting also to hear more about you and your background, because you're a very experienced professional in the financial industry. And so you have explaining this new asset class from a person such as yourself is got some real gravitas to it.
So sure, be happy to. So simply put, Salt Lending, we provide sort of collateral backed loans against the value of somebody's digital asset portfolio. So we allow people to hold Bitcoin, Ethereum, stable coins, and a couple other digital assets that they're able to then borrow against it up to a 70% LTV, which stands for loan to value ratio, so that somebody can be owning an asset, but still tap into the value of the asset while they continue to maintain ownership. And I think one of the things that I feel like has really changed over the last 5 years is that capability is now opening up strategies that, the ultra wealthy have leveraged for centuries in terms of borrowing against their real estate portfolios, borrowing against their stock portfolios to fund their lives, to fund additional investment. And now that's being opened up to everybody. And in particular, we're at a time. So one of the things I do, I'm an adjunct professor at the University of Colorado, and I teach strategy and entrepreneurship. And one of the things I've done at the university, I created the first Bitcoin and blockchain course and started to teach about both the technology as well as how it can be used. And when I have conversations with students who are struggling to buy their first home or get into other assets that they might be able to leverage to build wealth, Bitcoin and other digital assets may be the right thing for some of them, but they at least are offering a different path to both build financial literacy and understand how a lot of those mechanics work, as well as hopefully help them build wealth. There was a stat that went by the other day that the average age of home ownership is shifting from around the early 30s to the early 50s because of the price. And partly because the baby boomers, right? We've got this huge group of people that are holding on to homes and sort of driving up the price because they don't want to leave their home. Now that will pass, but right, that's going to be sort of another 20 years before that wealth transition takes place. And so there's a big gap for people like, how do I start to create wealth? How do I learn about financial tools and instruments now? So, I can be prepared and I can live the life I want to live.
That's really good. And it's the growth of the economy and new asset classes come online. And like we see things like hedge funds, people, if they understand the history of that was a new thing in 1956. So we do see development in the marketplace, new financial products. And I guess, this is one area where, Sarah, I really want to defer to you because you have some really good technical knowledge about this, more so than me. But I'm going to ask the one technical question, if I could, Hunter. I heard about this the other day, that with the rise of quantum computing, that provides off-scale decryption capabilities, and that creates some problems for some of these currencies that are relying on the blockchain and the process of mining, which is as I understand it, the decryption. So I think that would be one question that I bet you have a good answer to. I mean, I have an answer, and it is a concern that often comes up, and the sort of public-private key encryption that's being utilized in digital assets, Bitcoin, is a real enabler in terms of being able to sort of protect as well as share your information and encourage transactions and encourage commerce. I think the quantum threat, everybody I know, and there is actually a big quantum research center at the University of Colorado, is one, we're a ways off in terms of being able to reliably do that. But the other thing that is important to note, that it wouldn't just be digital or cryptocurrencies that would be at risk. It's essentially our entire financial system, because if somebody can break into any digital asset, they can also break into any bank, because everybody is using the same level of encryption, the highest levels of encryption that are available to protect digital assets. So it becomes a far bigger issue than sort of any one digital asset.
That sounds like a conversation for a whole other episode.
It becomes a really dark conversation quickly, but one that I know, people are thinking about and people do worry about, right, in terms of how to protect their assets in the event of those sort of scenarios. But it is one that from at least talking to experts, we're a ways off from it being sort of more of a near-term threat.
Well, and it's also really important because what I heard you just say when you explained that is that crypto is new to a lot of people. It's not new to people who've been dealing with it since 2013. Although I suppose relatively new for a new type of asset class in that context too. But in the end, threats that crypto-related threats or digital asset-related threats are also digital anything-related threats, which is our entire lives now. This is what I heard you say, right?
Absolutely.
So if you're going to get doomsday about it, there are bigger issues to be doomsday than only, it's not just the crypto, the digital asset class, I should say. And I do think it's very interesting because what I think that the rise of the blockchain, first of all, probably made a lot more people who weren't super deep into the tech details try to have a clearer think about what's going on with this blockchain. And then from there, you come into this question of digital assets. How do these things get mined? How do they create? And then you get into these bigger questions of what do you even mean by storage of value? What is money based on? Which is, if you're in the financial industry, and especially in a bank, you already are thinking about these things. But the average person doesn't. But I do think one thing I like about cryptocurrencies or the generally digital assets, it challenges us all to be even that much more financially literate and really think about what storage of value means. Like, why would we not value Bitcoin, but we do value dollars when arguably dollars are backed by something and Bitcoin is backed by something, right? And none of it is gold.
Yeah.
So I do think, just from the point of view of, and then of course now I think everybody is saying that it's an established asset class. And so, and many people who are first movers in investing, which is usually ultra high net worth people. I think we discussed that a little bit before when we talked is, they're already investing in this. I guess they also have risk appetites to try new things that average people don't. But then if you do you want to get more into this, this idea you just introduced, which is wealth building, because we like to talk about wealth building here. And a lot of commercial real estate people are really into their wealth building journeys. And we had talked about that before, that there's this financial literacy piece. In your case, it's actually a digital asset that you're able to use for leverage. Do you want to talk about why that's important in more detail for the economy as a whole and how that relates to unsecured and secured financial literacy, basically, about those two differences in terms of borrowing?
Yeah, be happy to. And Sarah, let me also go back and address one of the questions you'd brought up a little bit, just in terms of my background, just to help frame a little bit of my response here, because right. I have a very non-traditional background for a lot of the stuff that I'm looking at and talking about. So I have a PhD in systems engineering, and AI was sort of my research when I was at the university. I went to the University of Virginia, and I got into financial services because of the optimization work I was doing, both in terms of risk underwriting as well as sort of marketing models and portfolio optimization, both in terms of stocks as well as then unsecured lending, and really started to take an approach from unsecured lending to evaluate lending portfolios like stock portfolios. So every individual customer had a level of risk. They had a level of potential return that was both based on their credit score, based on the size of the line, and based on sort of their expected behavior. And I mean, that shift in the U.S. is relatively recent, right? That shift was being made in the 90s in terms of where we really went from regional banks to national banks and started to use a much more of a data-driven approach. Now, it is all the algorithms and a lot of that work is still fundamentally the same, but because we have so much more data, we have so much more compute power, the things that companies are now able to do with basically the same neural networks are much more powerful in terms of fine-tuning the offers, fine-tuning the marketing. But it's definitely been on a journey that is really not that old in terms of the sort of financial system as a whole. And in the U.S., I think there's two things in the U.S. that we've probably learned bad habits around. One is the fact that we have become really used to the dollar and the stability of the dollar. And I think to the point that was being brought up is that a lot of things now are helping I would say, are helping us because they're helping challenge maybe some of our beliefs that we have, and they may not be as firm as we thought they were. And that is like, we are very much in a world of probabilistic systems and not deterministic systems. And I think we have to recognize that while we think the dollar's stable, it may not be stable. You think GE was a great asset. It's not necessarily a great asset now as it used to be. And so things can change. And as we look and as I think about financial investments and financial assets, need to be aware of both the upside and the downside, but also the timing and the context in which that investment may be leveraged or may be utilized. And so I really sort of cut my teeth coming out of sort of academia in the unsecured lending world. I built marketing and risk models, and then I went to run global credit card and loan portfolios. I headed up all unsecured lending for Barclays Bank in the UK. I was chief marketing officer for the Halifax Bank of Scotland in the UK, and then did substantial work with MasterCard and Visa globally, really sort of helping global banks build their credit card, payment card, and lending portfolios. And so have a real perspective there. But unsecured lending is helping introduce new capital into whatever fiat ecosystem it is. And so it is another source of dollars or another source of capital into that ecosystem, which has good things and bad things. One of the potential negative impacts is potentially inflation, depending on the environment and the other things that are going on. It also does provide liquidity for people and helps encourage commerce and encourage growth. But at the same time, I think, especially speaking from sort of a more U.S.-centric perspective, it also doesn't necessarily teach the best habits in terms of savings. We are, anybody that is leveraging unsecured credit is taking an advance on future earnings. It's a promise to pay back, and there's a give and take there with the bank in terms of their willingness to take a risk. But compared to secured lending and borrowing, where you have to accumulate the asset first, I think there's just some really fundamental differences that in the age we're in, I think it's very beneficial and a positive step to be encouraging people to accumulate assets first, then figure out how they can leverage those assets and to what degree they should leverage those assets in terms of obtaining both liquidity as well as building wealth.
And Roland, what we discussed before, and thank you, Hunter, I knew that once we asked the right questions, you were going to really be able to explain things really in such a clear manner. But I didn't know that I had, or perhaps we discussed it, they had started off really solidly in academia. And it's probably good to note that, the AI is having its major heyday at the moment, but it did start somewhere in the past as, with what made sense in the time. And so I think that's really a whole other conversation to hear your views about what's going on with that. But Roland, when we were first talking, I thought it was just really interesting, the correlations between what he's saying, and he's using this crypto or this digital asset class in respect of the same things that people, all the people who are involved in the commercial real estate industry talk about, which is how to make your money work for you or work double time. And that's exactly what you're saying, right, Hunter, is that you accumulate an asset and then you make it work for you double time. You have it appreciating, hopefully, in its own right, and then you have it supporting you in terms of other investments that you can make.
That's right. And I mean, for the customers of Salt Lending, there's three primary use cases that they are borrowing against their crypto assets for. So the first one is just life. Like shit happens, right? And they got to figure out sort of how to pay for it. And whether it's a car repair or they're paying for school, they borrow against their assets to be able to cover those expenses. The second use case is income supplement, income replacement or income supplement. And so we have a lot of customers that want to, travel or work less. And so they'll borrow against their assets on a planned schedule in order to supplement their income. And then we have a range of customers that are fully retired off of their assets, and they are borrowing against their assets to fund their retirement And included in that is a very sort of tax efficient scheme that they sort of manage, because the loans themselves don't drive any sort of taxable events. And so that enables people to sort of have some flexibility with how they think about that and they manage their portfolio. And then the third use case is investment in other opportunities. So they have made a decision to buy Bitcoin, to buy other digital assets as a first stepping stone. And then a second stepping stone might be to then buy real estate. It might be to buy other income generating assets that they can either get dividends and additional income streams from, and or other tax write-offs. And so that is what I think is really interesting about some of the direction and the benefits of the unsecured versus secured lending. And Sarah, I think, we've talked about, I feel like the conversations we're having with customers, while we are not experts or advise in all those areas, people are starting to ask really, deeper questions about how do they manage their assets? How do they make a shift from labor-based income to asset-based income in terms of living their life? And what education do they start to need to be able to do that?
Well, that's great. And I think, what I like about the secured borrowing aspect of this is, you said it, that the person has accumulated sufficient amount of assets to show that they have some acumen with respect to financial matters. Some people, it's going to be 100% hand mouth, but everybody, we, just as responsible investment advisors, we'd encourage everybody to implement some kind of savings program. And over time, those savings can accumulate, and whatever you invest in, you do have an opportunity, whether it's buying stock on margin or getting a line of credit against your real estate, your home. People do that all the time. Home equity line of credit. There are other, like infinite banking is one thing, borrowing against your life insurance policy. All these are examples of first instituting that responsible savings program to create an asset and then being able to borrow against it. And I think, that's probably reflected in the interest rates as well, isn't it, Hunter?
It is to an extent. I mean, from a digital asset backed loan or, sort of a Bitcoin backed loan, the rates are starting to come down, largely because more capital is coming into the markets, so that people are trusting the value of the underlying assets. They have greater trust in the companies that are in the space. Crypto in particular, right? It is a bit of a wild ride and sort of an interesting sort of experience, because it is still a lot of trust building in terms of the companies and the people. And there are a spectrum of activities out there that are not all equal. And just like all stocks that are not equal, I look at some of the assets from going, if you think about stocks, going from sort of the penny stocks to the blue chip stocks, right? They're the same things that happen in crypto. And so people, there is complexity, and I think it for those that are interested in it, there's a lot of information out there. There's a lot of good information that's out there, but it's still, people do need to seek advice, seek experts, and try to educate themselves so that they understand the difference between a Bitcoin or Ethereum versus a meme coin from a digital asset perspective, and what the pros and cons are.
So just to follow up the one thought, and you're going to be able to ask a better question about this, but the security aspect, and I bet there are rules about where you custody the crypto in terms to be able to secure these loans. But Sarah, that would be interesting to me, is hearing about some of these technical requirements for, security, just for the asset itself, but then also what, hearing from Hunter, what requirements would be as a lender, what do I do with my crypto? Do I have to hold them in a separate account, or those types of questions really make me curious.
Yeah.
Well, I would say, Hunter, can you speak to that? Because I do think part of what we are trying to do with this, I think, and maybe you have a lot of experience talking about crypto with people, but there probably are different levels of what people understand. And without getting into the technology of how how coins are created, there is an issue with storage and custody, partially because of the ability to hack. Well, I guess once you're live online, then it's possible to be hacked. So would you like to just give us a little bit of the framework about how, as a lender, you would approach? I mean, there are two sides to it. One is your credit, your assessment of when you give a loan and what criteria you look at, and then also the underlying infrastructure for how you support the asset.
Yeah, so let me start off at an individual perspective here on the custody, because I think it's important to understand, and it is one where, from a sort of a fiat or sort of a dollar perspective, we don't necessarily sort of run into. I guess we could, but it's not as common. So one of the things, when you are an owner of a digital asset, and I'll be using Bitcoin as an example just to focus on one to start, you have the choice of a couple different modes of custody. You can self-custody, and this is the equivalent of basically having cash in your house, having sort of, cash under the mattress. You are responsible for it, and it's your responsibility to manage it.
I just was holding up a little data stick, and I could have a bunch of cryptocurrency on this, right?
Yep. Right. So, and then if you are doing your custody, you could have what would be referred to as cold storage. So you can actually print the address out and have it on a piece of paper that you can then secure sort of in a safe, something that has the level of protection, or you can have it on a digital wallet. Where you then have access to it. And there is a range of custody strategies depending on the amount of digital assets you have and how you diversify that. But one of the key things is that I always remind people of is that when you are choosing self-custody, whether it's with digital assets or if it's with physical sort of dollars and gold, you are responsible for the security of it. And that's both from theft as well as sort of disaster, right? Fire, water damage, or just sort of negligence in terms of losing it, misplacing it, having it walk off, because, there's multiple stories of people having hard drives thrown away that have million and now essentially billions of dollars worth of crypto assets that got thrown out accidentally. So there is a level of technical competence and sophistication and knowledge that is needed to do that. But secondly, you also give up on some of the opportunity that you have by trusting a third party to managing it. You give up on some of the leverage or liquidity that you might be able to get out of it. You give up on their level of security that they could protect yours, in conjunction with protecting a large, other people's sort of assets. And so there are pros and cons in both scenarios. And, I think that's an individual choice that people should educate themselves on. And also, I think it's one that changes across your portfolio. So there's not a one size fits all for all of your assets. It just depends a little bit of what you want to get out of it.
So what are the requirements for SALT lending?
So now shifting into SALT lending, and from a sort of a participant in the ecosystem, a provider of services. Firstly, SALT lending and the lenders in the U.S. all have to be licensed. So they either have to be a bank or they have to be licensed on a state-by-state level to be able to do lending, to be able to do money transmission. So I think the U.S. is moving in the right direction in terms of transparency around regulatory requirements, helping to build trust with the consumer base, the customer base, about what hurdles licensed companies need to meet regarding security, stability, liquidity, and sort of custody management practices. Internationally, that's continuing to change sort of rapidly. All the countries are starting to introduce more and more specific requirements for being licensed in the different jurisdictions. For SALT, we're licensed in 47 states in the United States and over 11 countries worldwide, and we continue to pursue licenses to be able to lend and work proactively with the regulators on sort of how to manage it as more people are wanting to sort of understand what's happening. And it is consistent with the general philosophy of a lot of the participants, right? The Bitcoin and cryptocurrencies and the decentralized movement were started to really drive for more transparency, more clarity in terms of what's happening with the assets, and seeing that play out not only in terms of what companies are doing, but what information companies are starting to share with their customers and with the broader ecosystem.
Hunter, it's interesting. I do think it's really important that people who have a long experience with the financial system talk about crypto, because it diffuses some, maybe, I don't know if they're prejudices, but when I hear you speak and others that I speak to sometimes about different aspects of the crypto industry, it always strikes me that, a lot of people do know a lot and exactly what's going on with this industry, including, there are the stories that come out about the negative things. And so it's, I think it's just really important that people like yourself get out there and say what, from the basis of your knowledge, what it is that, because just by explaining it and what your analysis process is, it just sounds very typical. There's a risk analysis. There are different criteria for how you go about solving a problem. There's a custody problem with any kind of asset, including data of any kind. Yeah. Well, I was thinking when you're talking about the cold wallet versus self-storage, et cetera, in the early days when companies were starting to go digital, and the question was, do we use a cloud service? And it's kind of a similar issue, like who has custody of our data, our company data, and who do we trust? Do we trust the professionals whose job is to protect it, or do we trust ourselves? And people made errors on both sides, but probably usually by keeping it themselves, because you can't invest enough in that area usually. So I think it just strikes me that we've got, just available tools, all of us, to understand this relatively new asset class and use it intelligently. Some people have jumped on it super easily. Others, we lag maybe a little bit more. But I do appreciate that, it's become, I think, a standard, just a typical asset at this point. And then,
yeah. And I think you're right. I mean, the custody and the risk assessment, I think, is becoming harder for all of us as consumers and participants in the digital economy, whether that's, how do we sort of evaluate the custody of our data with companies? Are they doing what they say they're doing? As it moves on to the same thing about sort of the crypto assets and how we think about what's happening with banks and other people that we are entrusting to be sort of the stewards of our money, the stewards of our assets, is a really important thing. And companies have different approaches, right? I mean, we look at that. We have some offerings where we use a sort of segmented approach to custody management, where we pool the collateral and break it up across qualified custodians to be able to reduce the surface area of attack, right? We're trying to manage a third-party risk. What happens if? And so that's one of the things that we do for a lot of the collateral that we custody. We then know that we can stack as much security against that custody, that collateral as possible, and so have a lot of confidence. And so we start to give customers choices about what is the custody model they want, because definitely within sort of the digital asset space, people come in with opinions about what is right, with or without the technical knowledge, but we want them to feel secure in what they're doing. We try to educate and tell them what we're doing on the different risks, like how do we manage it with security protection and protocols? How do we manage it in terms of distribution or decentral distribution of the assets to protect from sort of third-party risk? How do we manage it with insurance? What can they do on their side with insurance and other related tools to protect it? And given it is somebody's life savings, I think it is important, one, to be transparent with the information, and two, help educate people on how to think about it because there's pros and cons with all the answers. There is no bulletproof solution here that will protect everybody. We're just trying to mitigate the risks as best we can, given sort of the objectives, that different people and different companies have.
So I just want to say it again for our audience. This is SALT Lending, and we'll put contact details that Hunter shares with us if anybody who's listening is interested in reaching out and understanding more about what services they could receive from SALT Lending. And then also generally, I guess, Hunter, if you're interested in fielding any questions about crypto in general or anything else, your contact details, we'll share which ones you want to have for us. But since we've discussed SALT Lending, we've discussed a little bit the importance of wealth building with using secured assets. But I'm kind of curious, and I usually like to ask this something. Just sounds like you've had a varied career. You've lived abroad. Now you're back in Colorado. Do you have a personal story with crypto, or just generally that you'd like to share with us, something that keeps you motivated to keep learning and growing and learning about new asset classes, et cetera?
So I was brought into, or was attracted into sort of Bitcoin and crypto and blockchain really because of my technical background. I was sort of fascinated to sort of see all the components that came together. And I think one of the things that a lot of people don't necessarily appreciate is that Bitcoin in particular, when it was sort of created in 2010 and then launched, was just a reassembly of all already existing technologies. There was no new technology that enabled that sort of decentralized and distributed system to be launched, and to date has not been compromised from a security. So there is something that I find really interesting in just the math, right? Bitcoin in particular, everything is governed by the math, going from sort of the rules about when blocks are mined, how much sort of Bitcoin will ever be produced, adjustments that are made to the network. And it's just fascinating to see how it was put together and how the incentives have been built to really sort of govern how the system behaves and the participants behave or are encouraged to behave. But the other thing that really drew me in is, and I think surprised me in terms of how much I've enjoyed talking about it and sort of even brought me to conversations like this, is it's hard to get into it without then starting to want to learn more about global economics, about macroeconomic trends, about some of the philosophy, how we think about wealth, about what money is and why does money have value, and is it sustainable? Is it forever? What are the sort of ups and downs of how that might unfold? And I think it is really different coming from having grown up predominantly in the U.S. When I've traveled around the world, like there's really different perspectives that are based on your local economy and your local needs, and the needs to move money from one place or another. And I think that was, having spent so long, especially in the global payment systems industries, there's no doubt that there was a bunch of great work that was done in terms of increasing acceptance globally to help encourage people to travel, to encourage people to spend. But there's a lot of inefficiencies now because of the advances in technology that are worth looking at. And the fact that, we can send peer-to-peer payments to pay for somebody that might do a digital design or do a piece of work, I think is fantastic because it's making the world smaller, but also raising lots of other interesting questions. And I think it's all those other interesting questions that continue to excite me about where digital assets will go and how will we make this change from where we are, from traditional banking, from TradFi into a new model, which is yet to be determined.
Well, it's super interesting, Hunter, and really enjoyed this conversation to learn more about this asset class. We try to be respectful to our audience. We're coming up on 40 minutes. So what do you think, Sarah? Do you think it's probably about time to wrap things up?
Yeah, sure. Is that all right, Hunter? Anything?
Yeah, that'd be great.
Any last tidbits you really want to get off your chest?
No, I think this has been wonderful. Really enjoyed the conversation and be happy. I can be found on X at Hunter Albright, and also on LinkedIn are probably the two best places to find me. If you want to learn more, do check out saltlending.com. But would happy to engage and answer any questions.
Great. Wonderful. Thank you so much for reaching out to us. And I'm really, already I've learned a lot, and I actually look forward. I hope we get to have future conversation.
Oh, would love it.
All right. Thanks everyone for joining us today on Alt Investing Made Easy. We hope you enjoyed this episode. Please like and subscribe and follow us.
And remember, everyone, take aim with your alternative investing strategies.
See you next time.